With SoFi Technologies changing hands right around the $19 level, Wall Street's consensus mechanical lens continues to completely misread the engineering reality of modern digital banking infrastructure. Traditional financial media loves to pigeonhole SoFi as a volatile online lender, a glorified fintech app tied directly to the whims of consumer credit cycles and interest rate fluctuations. But that linear framework misses the fundamental structural transition happening beneath the surface. SoFi is not a bank trying to build software. It is a vertically integrated software-first financial services powerhouse that has cracked the code on the customer acquisition cost bottleneck. While retail participants flood trading forums debating whether a 39x trailing PE ratio or a momentary macro interest rate tick makes the stock expensive, institutional algorithms are quietly capitalizing on a profound market mispricing. They recognize that SoFi's proprietary cloud-native tech stack, anchored by the Galileo and Technesis acquisitions, creates an unassailable structural moat that legacy brick-and-mortar institutions simply cannot replicate without completely tearing down decades of technical debt. The real physics bottleneck in traditional banking isn't capital adequacy. It is the archaic legacy spaghetti code infrastructure that forces financial institutions to spend hundreds of dollars per user just to cross-sell a secondary checking or investment account. Legacy banks are bogged down by mainframe architectures that operate like isolated data silos, preventing real-time product expansion. SoFi solved this through its financial services productivity loop, where software automation drives marginal customer acquisition costs down to near zero once a user enters the ecosystem. Retail investors scanning headlines are trapped in short-term sentiment loops, letting macro jitters shake them out of positions. Meanwhile, institutions see an architectural masterclass, a digital-first charter operating with zero physical branch overhead, generating high-margin fee revenue and capturing lifetime customer value at a scale that legacy institutions can only watch from the sidelines. Before we dive deeper into the operational mechanics, let's check in on where you stand. Are you currently holding a core position in SoFi, scaling in slowly during these macro-driven pullbacks, or are you sitting on the sidelines waiting for a deeper technical correction? Drop your thoughts in the comments below. Business model and historical context. To truly grasp where SoFi is heading, we must shatter the outdated historical framing that haunts the company's valuation. Years ago, SoFi entered the public consciousness primarily as a student loan refinancing startup, a niche player vulnerable to legislative changes and cyclical higher education lending trends. But characterizing SoFi as a monoline lender today is akin to describing Amazon as an online bookstore. Over the past several years, CEO Anthony Noto and his executive team executed a masterclass in business model transformation, pivoting the company into a diversified financial super app structured around three distinct, highly synergistic pillars: lending, the financial services segment, and the technology platform. The lending segment, comprising personal loans, student loans, and home mortgages, remains the powerful cash flow engine of the enterprise, benefiting immensely from SoFi's national bank charter acquired via the Golden Pacific Bank acquisition. This charter allows SoFi to fund its originations with low-cost insured deposits rather than expensive wholesale credit facilities, structurally expanding net interest margins in a way non-chartered fintech competitors can only envy. But the real magic and the primary driver of the company's explosive multiple expansion lies in the non-lending segments. The financial services ecosystem, featuring SoFi Money, Invest, Credit Card, and Relay, has evolved into a hyper-growth engine where cross-buying metrics are accelerating at an unprecedented rate, with over half of new product additions now coming from existing members. Concurrently, the technology platform, Galileo and Technisys acts as the AWS of Fintech, providing back-end processing infrastructure for hundreds of millions of digital accounts across external global financial institutions and Fintech disruptors alike. This dual-engine model transforms SoFi from a cyclical credit risk into a resilient, high-margin software and fee-generating powerhouse. Future outlook, catalysts, and risks. Looking toward the multi-year horizon, SoFi's growth catalysts are deeply entrenched in structural shifts in global consumer finance. The ongoing migration from legacy banking infrastructure to cloud-native, API-driven financial services is an irreversible secular trend, positioning SoFi's technology platform as an essential gatekeeper for modern banking infrastructure. As traditional financial institutions desperately attempt to modernize their aging back-ends to compete with nimble neobanks, Galileo and Technisys are uniquely positioned to capture massive enterprise SaaS contracts. Furthermore, within the retail ecosystem, the relentless expansion of the financial services productivity loop ensures that as members age and build wealth, their lifetime value compounds organically without requiring proportional increases in marketing expenditure. Of course, any objective analysis must address the structural risks and headwinds that accompany high-growth fintech models. Credit performance remains a critical focal point. Any severe macroeconomic downturn or unexpected spike in consumer unemployment could introduce upward pressure on loan delinquencies and provisions for credit losses. Additionally, increased regulatory scrutiny surrounding capital requirements for deposit-taking institutions and potential shifts in interest rate policies by central banks introduce operational variables that require continuous executive navigation. Yet when evaluating capital expenditure cycles and the relentless digitalization of financial services, short-term price fluctuations pale in comparison to the sheer velocity of SoFi's fundamental execution. Delivering consecutive quarters of record-adjusted net revenues crossing the $1.2 billion threshold alongside robust profitability proves that the unit economics are structurally sound and scaling efficiently. For the ambitious investor willing to look past short-term noise and macro crosscurrents, SoFi represents a rare convergence of software-scale economics and traditional banking stability, a rare asymmetric opportunity in modern public markets.